Hi, and welcome to Chapter 2, the Financial Market. In this chapter, we're going to discuss why financial markets are very important to financial managers and finance in general. Now, we have to start with the intermediaries. These are the key demanders or suppliers of funds. The three intermediaries we're going to talk about are individuals, businesses, and governments. These are the key players, or we call the key suppliers and demanders of funds in the financial markets and institutions. Now, in general, individuals are the ones who do most of the savings and thereby supplying most of the funds, while businesses and governments are the people who borrow the money and spend it, which we call net demanders of funds. This dynamic is created by individuals saving for retirement or saving for future events, and businesses wanting to borrow money through financial intermediaries to grow their businesses, and governments wanting to borrow money to fund their budgets and fund infrastructure spending, military spending, domestic spending. Now, it's not true in all cases, because some individuals are net borrowers, as they borrow to buy cars and houses, and some businesses are net savers, but by and large, the individuals are saving the most, and governments and businesses are spending the most of these funds. Now, let's look at the banking system a little bit, or how some of the big groupings in banking. So we have three areas we should talk about: commercial banks, investment banks, and shadow banking system. Sounds really cool, right? But it's not as cool as you think. So commercial banks are probably what you're most used to dealing with and seeing. So commercial banks are going to provide a institution for people to save their money, a safe place to put your money, and it's also a place where loans can be offered to individuals and businesses who want to borrow those funds. Now, commercial banks provide a lot of services in a lot of different ways for people to deposit their savings, such as savings accounts, checking accounts, certificates of deposits. And you probably know a number of these banks, like there's Chase, Wells Fargo, Bank of America, Citibank, US Bancorp, just to name a few of these commercial banks that both individual and businesses use as a tool to help manage their money. And the traditional business model of these banks is, paying interest to attract savings and then lending it out at a higher rate for people who want to borrow this money to finance small businesses, mortgages, car loans, things of that nature. And the U.S. Federal Deposit Insurance Corporation will insure $250,000 of deposits in banks that carry the FDIC insurance depository coverage, which is pretty much all banks. So what confuses a lot of people is, what is an investment bank? Investment banks are a little bit more unknown to the average person because they deal with businesses. They don't really deal with individuals. Now, what is the main purpose of investment bank? Well, one is to assist companies in raising capital. So they help companies, they're mostly smaller businesses will work with commercial banks to borrow money because they need bigger businesses need a lot more money, so they're forced to work more with investment banks that have access to capital markets. So these investment banks are also going to advise these companies on major financial decisions such as mergers, acquisitions, financial restructuring, and they're also going to engage in trading and market maker activities. So if you're a client of this investment bank, you're either going to be a big business, although it's possible to be an individual with very high net worth, multimillionaires. Sometimes government, pension funds, and other financial institutions will work with investment banks. Now, the big investment banks, you have Goldman Sachs, Morgan Stanley, Barclays, Credit Suisse, and they are well established and they have a good connection or network of transactions and that can meet clients' needs, they could basically say. So these are well established, and it's all about, when I say connections or transactions, it's all about how these investment banks can connect your money to other businesses, to other opportunities. So they often are sort of like a corporate market maker in the fact that they bring businesses together to merge. They'll help businesses find acquisition targets. They'll help companies issue corporate bonds or do an initial public offering. So these are things that regular banks don't do. And commercial banks are extremely profitable and usually a very prestigious place to work. Now, the shadow banking system, this is something that evolved over the last 20 years or so, maybe even 25 years. And there's been a big growth in this area. So when we say shadow, we mean these are ways of borrowing money that are outside of the commercial or investment banks. Now, so these are a group of other financial institutions that are going to lend money. So they do it much the same way as traditional banks do it, except they don't accept deposits. And the key thing about not accepting deposits is that you won't fall under federal banking regulations. So if you have less regulation, you have a little bit more flexibility in how you lend your money out. So you take, for example, a mutual fund or insurance companies or pension funds. They may have excessive extra cash to invest. So what do they do with this extra cash? They might, put it in the shadow banking system to get a higher return on that money. And this wouldn't be considered a individual deposit because this is from an institution. Now, so the shadow banking will channel this money from these big institutions that have large piles of cash laying around, which might be a short term. They're going to thereby kind of move these into loans that are going to earn them some additional return higher than they could get maybe in a traditional bank. So these shadow banking systems actually, they work with a huge amount of money. And, we're talking multiple trillions of dollars that they help shift around in the financial markets, basically connecting large organizations that have large sums of cash to people who want to borrow it. So they facilitate this movement of money from people who want to borrow and people who want to lend, but they don't do it with any individual private citizen deposits. And that's why their activities are less known because they're not as regulated. So, for example, a commercial bank is highly regulated on the transactions they're allowed to perform, on what they report to the government. For example, if you make a withdrawal deposit greater than $10,000, that will be reported to the government. And, so there's a high amount of regulations on these commercial banks, including how much money they have to hold in reserve. And so all these regulations are sort of a drag on their profits. Where the shadow banking, they don't have the same regulations. So they are a little bit more cost effective and can offer a higher return to lenders and a smaller cost of borrowing to borrowers because they don't have as much oversight or overhead. Now, this shadow banking can be an issue because, it's hard for economists to really see what's happening in the shadow banking area in the governments as well. But it does provide a key point of liquidity for the economy and has helped the economy grow substantially over the last 20 years or so. Okay, so let's move over to the consolidation in the U.S. banking industry. So what happened here is that there used to be many more banks, many more local banks, small banks. For example, there was a bank called the Bank of Long Island, the Bank of Smithtown. These were smaller banks that got gobbled up by bigger banks. So the number of commercial banks declined from a peak of around 14,000 to today's estimate of closer to around 5,000. And, this decline of 65%, is the gobbling up of these smaller community banks. These are chains of banks that may have had 8, 10, 12 branches, or could have been larger too, but a lot of these big banks rolled in, like Chase, Citi, TD Bank, and they would come in, and if they want to establish a marketplace, they would buy these smaller banks to grow their network of banks. This was a number of years ago, before the Great Recession. Washington Mutual was so aggressive in gobbling up these small regional banks to build a huge network of banks, Washington Mutual, that eventually, due to the Great Recession, got into financial trouble and was purchased, I believe, by Chase. Now, why do banks want to be big? Well, it's appealing to customers. If you belong to a bank like Bank of America or Chase, you get to see that no matter what state you're in, there's a Chase bank. So it's easy to use a Chase ATM, visit a Chase teller, because it's a very big network. So you don't have to really worry about finding access to your bank. Now, smaller, more regional banks are smaller. So if you leave a regional area, you don't have the same magnitude of scale. So the customers are generally attracted to bigger banks. So there's a relationship there. Now, let's move on. Let's talk about the financial markets a little bit more. So what's the relationship between institutions and the financial markets? So the financial markets is where everything is basically happening in the financial market. So it's a forum of suppliers and demanders to transact their business directly in this financial market. Now, we break up the financial markets into a short-term market called the money market and a longer-term market called the capital market. Now, what is the relationship between financial institutions and the financial markets? Well, the financial institutions are businesses generally that are going to actively participate in the financial markets as far as moving the flow of funds between suppliers and demanders. So, we're going to talk more about this in a minute. But I also want to mention, before I go more into this relationship, the private placement. So this involves the sale of new securities directly to an investor or group of investors. So this private placement would be that maybe there's a newer company that's not ready to go public. So they'll do a private placement to sell some of their stock directly to private investors, or sell some of their or make loans directly to private investors before they're ready to go to a bigger public forum. But most firms, when they're big enough, they're going to raise money through this public offering of securities. And when I say securities, that means either IPO stock or issuing corporate bonds to the general public. Because there's a lot more money in the public offering space than the private placement space. And this is going to bring us to the primary and secondary markets. So when we talk about the primary and secondary markets, what we're talking about is, think of primary as brand new. So think of a textbook. If a textbook is brand new and you buy it in the bookstore, that's a primary sale of a textbook. A secondary sale of a textbook is when you're done using the textbook and you want to resell it to somebody else. That would be sort of a secondary sale, or sale in the secondary market. So you think of buying a new video game directly from the manufacturer, or you get the brand new video game, you open up, you play it, that you're buying would be what we call primary market. You're buying that game for the first time. Then if you want to go and resell that game to GameStop, that's a secondary market. And GameStop's going to sell it to somebody else used. Now, the thing to note is when a company, say you're a company, a software company, a textbook company, or a company that sells stock, when you sell in the primary market, you're going to get money for that sale. But if someone resells your stock, resells your textbook, resells your video game in the secondary market, you don't benefit from that. And that's a key terminology that you need to understand. That companies only are going to make their money when they initially sell the bond, initially sell the stock in the primary market. As it trades later on in the secondary markets, they're not going to get any money from that. Now, if a company does own some stock that they have in-house as treasury stock, they will only benefit if the stock price goes up, then their value of their shares go up. But they don't get any benefit from the trading of that stock. So that's sort of the relationship between institutions and markets. So institutions are going to want to use the markets to raise funds, primarily raise capital. And in the secondary markets, is good for help valuing the company. So when you see the value of a stock, it gives you an idea what the value of the company should be. So, the financial markets are not only supported by the issuance of new securities, such as stock and bonds, but the demand of, investment capital in general is going to help fund the flow of transactions in the financial securities among investors, usually in the primary and secondary markets. Now, this is a flow chart of basically what I'm trying to say. It might be easier as a visual here. So what we see here is this. Let's talk about private placement first. These are people. Think of big investors that have a lot of money. They could skip the financial institution and financial markets and just go directly to the people demanding the funds or the people supplying the funds. So in private placement, you're going to have this sort of cycle here where they can buy ownership in companies directly or make loans to companies directly outside of dealing with the financial markets or financial institutions. So they can interact with the demanders of funds. This could be companies that want to borrow money or supplier of funds. These could be companies or individuals that want to provide funding. So private placement can take place outside of the traditional markets. But most of the activity is going to take place between the financial markets and the institutions. So the financial markets, think of the stock market, the bond market. They're going to enable the trading to take place. So there's a location, whether it be tangible or intangible, where people can buy and sell stock and bonds. So financial institutions are going to connect the suppliers of funds to the demanders of funds, but they have to go through the financial markets. So we get this cycle where individuals who have money, they want to save that money and bring it to saving institutions like banks and even brokerage accounts. Then these funds, financial institutions are going to help transfer these funds to the demanders of funds, the businesses and the governments. And they do that by going through the financial markets to bring the funds to financial markets and provide the securities back to the supplier of funds. So thereby transferring the money from people who want to supply to the people who want to borrow that money. All right. Let's talk about some of the markets within the financial markets. We have the money market, and typically the money market is for securities that are less than a year. It means the life of security is less than a year, like a 3-month certificate of deposit, or a 6-month certificate of deposit, or a 1 year, or a 6-month treasury. Now, the money market, think of it as low return, low risk. So these are short-term debt instruments, and it could be treasury bills, commercial paper, certificates of deposits. Just typically, they're going to last for less than a year, and there's going to be a very low risk associated with them, but there's also going to be a very low interest paid on these money markets. But they still have a value because there are people or companies that want to invest their money in a very short term in a very safe way. So their choice may be have their money in a zero interest-bearing account where they're not receiving any interest or receiving very low interest, or moving your money into a 6-month treasury or certificate of deposit to get more interest. So if your choice is maybe their savings account, the corporate savings account is only paying 10 basis points. Think now, as far as a basis point, 1% of interest is 100 basis points. So 10 basis points is 10% of 1%. But maybe they could go to a money market, treasury bill, and they can put their money and earn a 0.5% interest on it. So thereby, with very little additional risk, they could greatly increase the amount of interest. And when you're talking about having millions of dollars temporarily lying around, that money adds up. The interest you can make on that can add up quickly. Now, this brings us to the next market, which the euro currency market is a market where dollar-denominated deposits are made, and it's a whole market of borrowing and lending dollars outside the U.S. banking system. So it could be a company in Germany, a bank in Germany that makes loans or accepts deposits in dollars outside of the U.S. banking market. So why would they do that? Well, one, there's no U.S. regulations on these euro markets because they're outside the U.S. jurisdiction. And there are some businesses that are barred from doing business in the U.S. because they're considered a conglomerate, like De Beers, a diamond industry from South Africa, or it could be a country like Russia or Iran that don't want interference from American regulators due to sanctions or other political concerns. So there's a whole market of dollars that trade for deposits and lenders outside of U.S. control. And that's a pretty big separate money market that exists. Now, there's also an even bigger market is the capital market. So this is where suppliers and demanders of long-term funds are going to make transactions. So these are funds greater than a year. So the biggest areas here are bonds and stocks. So those are the two biggest areas of trading in the capital markets. So these securities are what we call debt and equity. So bonds would be called debt and stocks would be called equity. So when we're talking about bonds, and we're mostly talking about corporate bonds, these are bonds for businesses, or government bonds, which are used to raise very large sums of money, sometimes in the trillions of dollars, to fund governments and businesses. So the bonds, typically pay a periodic interest rate, and the borrower's going to pay the interest and principal back to the bond investors at a certain maturity date. Now, bonds are probably in some markets more relied on by corporations to raise funding because they can be initiated, quite frequently, more frequently than you initiate an IPO. So a company generally initiates IPO once, where they can issue many different corporate bonds over many different years. Now, speaking of equities, when we talk about common stock or equities, this is, where companies do an initial public offering to sell some ownership in their company for investors who want to have a piece of that business and share in the capital gains of that business. Ideally, the companies will use that IPO to invest and grow their business. So, for example, when Chipotle Mexican Grill was an up-and-coming company, they had an IPO, raised a large amount of money, and used that money to fuel hundreds of new restaurants to be opened, thereby growing the business even stronger. So investors are willing to lend them money knowing that it's going to be reinvested to grow the business and make the business even bigger for everybody involved. So even though they give up a portion of their ownership of the business to issue the stock, they're able to grow their business much faster with the capital that they raise. Unlike bonds, when a company issues bonds, they're not selling any ownership, but with bonds, you have to pay interest on that money, which is another burden on your cash flow. Where stock, you don't have to pay interest or dividends, and so it could be a zero drain on your cash flow, and just a positive addition to your cash flow. Now, there's also, in the stock area, we do have preferred stock, which is sort of a hybrid between bonds and stock, but it's closer to stock. So it's giving you ownership of a company, but it's also giving you a guaranteed dividend over a specific, where bonds will be a specific period of time, say 10 years or 20 years, and more commonly 30 years. Preferred stock, like common stock, has no end date. So it's like a bond where you're going to get a stream of income from it, but it's like a stock where it doesn't expire. Okay, So let's talk about the broker markets and dealer markets. These are just how the capital markets are organized into these two subgroups, broker markets and dealer markets. Now, the security exchanges, and these exchanges are these are the financial intermediaries that are going to provide a marketplace for which firms can raise money to sell new securities, or they can sell bonds as well, and different depending on what the security exchange is. Now, mostly what we're going to be talking about here is the stock security exchanges. So with the broker markets on these security exchanges, you're going to have exchanges in which two sides of a transaction, the buyer and the seller, are going to be brought together to trade a security. Now, trading takes place on a centralized trading floor on these broker markets. And the most common one would be the New York Stock Exchange, which is also recently merged with the Euronext exchange. And they also maintain and operate regional exchanges. So these exchanges have a physical location. So the key thing to remember here, with the broker market, is that there are two sides of the transaction represented, and the buyers and sellers are brought together in some sort of physical market to trade their securities. Although broker markets do have a substantial amount of computerization these days, where not all transactions are as physical as they used to be. And the dealer markets are going to be a market in which a buyer and seller are not brought together directly, but instead have their orders executed through securities dealers who are called market makers for a particular security. And the biggest dealer market would be the NASDAQ, which is part of the over-the-counter market. So the buyers and sellers are going to transact through a computerized network, and they're going to operate through groups of companies or individuals that are called market makers, that basically make a market for individual stocks. Now, the dealer market and the broker markets, as far as you as an investor buying stock, you'll see no difference on your side when you actually buy or sell a stock. Generally you won't know if it's a broker or dealer market, and you won't see a difference in your transaction because you'll be making all your transactions online. So the dealer market, even though it has no centralized trading floor, it still has the largest number of stocks involved in the dealer market. So most stocks are in the dealer's market, and the market makers are just going to try to link up through mass communication, telecommunication tools or network, sort of like the internet, buyers and sellers. So they take, in some cases they may hold, if they make a market, say for Cisco stock, they may hold an inventory of that stock, or they may, look to compete to take in, bid and ask offers and match them up of different investors willing to transact in that stock. So there could be, Cisco might have 31 to 50 market makers. They're all competing to get the transactions coming in. And by the regulation of the stock market, the market maker who offers the best deal is the one gets placed at top to make the transaction. So it's sort of they are competing against each other to capture the buying and selling of the stock. Now, so what do the market makers offer? They're going to offer an ask price and a bid price. So if you're the market maker with the best ask price, you're going to be placed on top of the order. So the next person that comes in that wants to buy the stock, if you're offering the best ask price, they're going to buy it from that market maker. Now, the market maker also offers a bid price. And from your point of view as an individual buying stock, when you buy stock, you're going to pay the ask price. And when you sell the stock, you're going to be paying the bid price. And at any point in time, the ask price might be $5 and the bid price might be $4.75 at the same point in time. So which means that if you were to buy and sell a stock at the same point in time, you're losing 25 cents a share automatically, because you would have to buy it at $5 and sell it at the bid price at $4.75. The difference between the bid and the ask is called the spread. And that's the profit or the compensation for the market maker. And that's why they are taking their time to make a market and match up buyers and sellers, is because they want to collect the spread. Now, if you're buying a stock, not only are you going to have to absorb the cost of the spread, there's also generally broker commissions depending on who your broker is. And a lot of these broker commissions have been reduced to zero and the hyper-competitive nature of the markets that exist today. Now, there are international capital markets, such as the Euro bond market, the foreign bond market, in international equity markets. So capital markets aren't just limited to the U.S. markets I was talking about. They're found around the world. And typically there is a large volume of money transacting in the Euro bond market or the foreign bond market or international equity markets. And many countries have their own stock exchanges that their local companies will exchange on. Such for example, some of the bigger local stock exchanges. Japan has a local stock exchange. China has a local stock exchange. The European Union has local stock exchanges, and in some individual countries also have their own local stock exchanges. Now, some stocks can be traded simultaneously on their local exchange as well as the bigger U.S. exchanges. So you take a company like Sony, they will be on the Japanese stock exchange and also on the New York Stock Exchange. So many of the larger companies will trade simultaneously on their smaller exchanges, regional exchange, and also seek to get access to the bigger exchanges like the NASDAQ or the New York Stock Exchange, because you have more access to liquidity and capital in those exchanges. But they all work together in the same way the U.S. markets work, is to raise money for businesses and corporations and governments to help fund the expansion of businesses or the budgetary needs of governments. And these, the Eurobond market, the difference between the Eurobond market and the foreign bond market is that the Eurobond market is going to be denominated in US dollars. The foreign bond market will be denominated by whatever foreign currency that market is originating from. So, for example, the foreign bond market is where you would find corporations trying to raise funds in euros. And the international equity market, when they sell, depending on what investors, if they're selling on the local regional exchange, it will be in that regional currency. And if they want to graduate or simultaneously offer their stock on the U.S. stock exchanges, they're going to have to convert their offerings into dollar denominations. And many companies are willing to take the extra step of converting their financials to U.S.-based accounting GAAP, and follow the SEC regulations and rules and laws to offer their stocks on U.S. exchanges in dollar denominations and pay dividends in dollars to get access to the large capital markets in the U.S. Now, what the capital markets do provide is some efficiency in valuing corporations and valuing the bonds. So this sort of interweaves into this efficient market hypothesis where securities, since there's a number of well-educated and well-financed individuals and institutions buying and selling stocks and bonds, the prices rise on stocks and bonds based on supply and demand. So if more people are looking to buy these stocks and bonds, the prices increase. And if more people are net sellers of these products, the prices drop. So it's sort of like investors are voting by buying shares for the stock price to go up or voting for the stock price to go down when they're selling shares, and creating what we would call the current value, or hopefully the fairly priced value of these stocks in today's market. So anytime you look at a stock price or a bond price, you say that this fully reflects the information available today. What's known about the security is reflected in the value of the stock price. So the markets provide what we call this efficiency or that sort of fold in everyone's collective thoughts and information on the stock to its current stock price. So theoretically, if it's the hypothesis to say the markets are efficient, so the stock prices today are the fair price that the stock is valued at, meaning this is what the stock is really worth. And investors shouldn't waste time trying to find stocks that are undervalued or overvalued. And typically this, for the most part, the efficient market hypothesis is pretty on target. But there are times of extreme overvaluation or undervaluation of stocks, such as in a bubble or a market, or an extreme bear market of stocks, where prices are greatly being sold at discounts, or prices are greatly inflated. What the market would say is that if you fully believe in the efficient market hypothesis, the stock price of today is always the correct stock price. But if you look at over time, there has been some extreme peaks of stock prices that would have said, this clearly was a bubble and the prices were not valued at that high. So there's sort of like a temporary periods where investors get ahead of themselves and overvalue certain securities that later on, when the true aspects of their earnings potential and their growth potential come out, the stock gets readjust and become more closer to what their fair value should be. Now, this is all. Why does this happen? Bubble markets and stock crashes. A lot of this has to deal with behavioral finance, or the role of people's emotions and their investments. So behavioral finance looks at how individuals. So if everything was traded by computers, we'd probably have a much more stable and much more fairly valued financial markets. But since most of the decisions are made by human beings who have emotions, and those emotions are projected into the decisions, this often creates periods of overvaluation or undervaluation in stock prices, and also may form predictable patterns in the way people trade. So there is a reflection of the human characteristics or the human emotions in their decisions and how stocks are priced. For example, very attractive stocks that have cool ideas or are very well liked products typically a little bit more overvalued than stocks that people don't understand as well or just aren't as sexy. So, a stock like Apple Computers maybe have a higher valuation as people love their products, but a company that may be a public company that run funeral parlors aren't as interesting or as sexy as Apple, and they may trade it undervalued because of people's less interest in them. Now, let's move into how the financial markets are regulated. So the financial markets in the past have caused great strife, booms and busts in the financial systems of societies, and this resulted in governments taking actions to help moderate some of these boom and bust cycles that financial markets can create. So the biggest boom and bust cycle that affected the regulation of financial institutions occurred in the 1920s and 1930s. So in the 1920s, we had this roaring bubble market in stocks that was fueled by a lot of misinformation or outright lying about companies. There were companies that were selling stocks that only existed in name and had no products and had no business, had no financial statements. But, people were so greedy, they were buying any and everything. The stock market went up tremendously. Then when the stock market crashed in 1929, and the following years of distressful stock market returns in the 30s, the government sought to take action to help protect investors and savers. Since so many people lost extreme amounts of wealth during this period, first thing they looked to do is create some regulations. One of the things that they wanted to do is they wanted to separate risky activities from more safer activities. So they broke the banks up into commercial banks and investor banks. And that's why we have those two classifications today, because they wanted to break up the banks that took in deposits from banks that were underwriting stocks and bonds, and have them be separately put into two different types of banks. thereby hopefully keeping the smaller citizen saver safe from the risky aspects of the investment banks. Now, in addition to protecting the smaller investor saver, they created the FDIC, which was a way of protecting your deposits within banks. So if a bank failed or a bank went bankrupt, you wouldn't lose your savings to the failure of that bank. The government would step in today to the tune of $250,000 to refund or protect your savings account, thereby creating or instituting more faith into the banking system. Okay. Now, following up with some additional regulations, and the FDIC is actually, they do have a similar program for people who have money in brokerage accounts as well, to protect money in brokerage accounts, or even money, they have a separate one to protect people who have money in credit unions. And credit union is sort of a non-for-profit bank. Now, the Gramm-Leach-Bailey Act, this allows commercial banks, investment banks, and insurance companies to consolidate and compete for business in a wider range of activities. So this sort of reversed when we talk about the previous act, this Glass-Steagall Act, this was sort of revised with this Gramm-Leach-Bailey Act. So it permitted these companies to compete in markets that prior prohibited them from entering. So with the removal of the Glass-Steagall Act, or the reduction of that, now commercial banks can merge with investment banks and insurance companies. And the idea was that this would make these companies more profitable and more competitive, and offer people a wider range of products and services. The Dodd-Frank Wall Street Reform Consumer Protection Act, which is a more recent act, looked to realign the duties of several existing agencies that require these agencies to report to Congress regularly. And this Dodd-Frank Wall Street Reform Act occurred after the Great Recession in 2008. So the Gramm-Leach-Bailey Act occurred prior to the Great Recession. Some say that this act fueled or created the opportunity for the Great Recession to occur. So the Dodd-Frank Wall Street Reform Act was a regulation brought on to help correct some of those. So various agencies affected or created by this Dodd-Frank Wall Street Reform Act are still figuring out how this act and its provisions are going to be implemented. So it's still something that is not fully, it's such a large act, it's still being worked through how that's going to affect the financial markets. But by and large, it's meant to protect individual investors in stock, bonds, and savings from being taken advantage of by larger companies that are taking bigger risks than they may understand. Okay. Now let's talk about go back in time, back to the 1930s. After the Great Depression, more regulations went in play because there was so much abuse in the stock market area that they issued the Securities Act of 1933, which is going to regulate the sale of securities to the public through the primary market. It's going to require sellers of new securities to provide extensive disclosure to potential buyers of those securities. So basically, this is going to protect people from buying fake stocks. There were so many fake stocks for sale in the 20s that people were gobbling up and not asking any questions, that this act was a way of legitimizing companies and making sure they were real and they had financial statements and they had to meet a certain set of guidelines and rules before they could bring their company public to individual investors. The Securities Exchange Act of 1934 created the Securities and Exchange Commission to help regulate the trading of securities in the secondary market. So, requiring that companies have to post their financial statements and disclose their financial movements to people who are investing in the secondary market, and put limits on insiders, people who own or work for the company, how they trade their securities, as far as the legal way that they can trade securities, so it's open and individual investors can see their movements before they actually buy or sell a stock, so they're not able to act on inside information, which would be an unfair advantage for them given their position within the company. Now, the Security Exchange Commission, which was created, and this is a big government agency that's going to be responsible for enforcing the federal securities laws. They basically can investigate, prosecute, levy fines against individuals that break these laws, and provide regulations for companies on what they need to do to be part of the financial institutions, financial capital markets. Okay, so we're going to stop here in part 1 of this lecture, and we'll continue, and we'll start part 2 with talking about issuing common stock and the difference between private equity and public equity.